So today the topic that we shall be discussing is about the equity valuation, and the equity valuation is something which is the backbone of your project consolidation. Okay, and at the same time, it's a very important topic for the track in general as well. And I have uploaded the topic 2 here, valuation of equity assets. And I would be recording it, and then I would be sharing the link with you at the end of the day. Right, but before we start, do you have any questions, anything you want to ask? All good in life? Okay, very good. But if you have a question, just raise your hand and I can stop recording, because I don't want to record your personal issues. Topic 4, no, not topic 4, that's something else. This one. Yeah, so this is what we shall be studying today, and I double check that it's being shared so that you don't miss out. Topic 2, valuation of equity assets. And as I said that in your project, when you will be doing the valuation of FinAir and KLM, and you want to do some bidding, either you want to sell KLM, FinAir to this French KLM, or you want to buy KLM, it will largely depend upon how you find the value of both companies and try to find which one is a good bargain. If you think that FinAir is overvalued and KLM is undervalued and you want to buy it, this will be proved through the valuation. And if it is opposite, if you think that I think it's a good time that we sell FinAir to KLM, then that will also be coming out of this valuation topic. So that's why this topic is pretty much important from strategic point of view. Valuation is very crucial for investors, portfolio manager, the corporate analyst, the corporate managers, regulators, researchers, and many people. You can have a look at this first line, and these are the designations, these are the different jobs, these are the different positions people work in the field of finance. And if you are unsure of any of these designations, please let me know. Investors, you know who investors are. The portfolio managers are those people who are working for the mutual fund or the hedge fund or the investment companies who are managing the portfolios on behalf of their clients. And the banks are also doing this job. Nordea has this kind of business, and or basically all the banks have. And then there are corporate analysts who work for example, the financial media, Reuters, Bloomberg, and they are analyzing the companies and giving their verdict if a company is overvalued or undervalued. The corporate managers, you can be a manager of a non-financial company called, let's say, Walmart or some other, or Nokia, for instance, and you are interested to know whether you should acquire a new company or not, or whether the share value of your own company, is it going down or going up? Should you be alarmed? So even though your main business, your operational work has nothing to do with the financial activities, but you want to check how the market is treating your stocks. Regulators, of course, if you work for any Securities and Regulation Commission and you find that the stock price of a particular company is going very steeply up or steeply down, you have a reason to be concerned of. Because if this company becomes bankrupt, there'll be a lot of people getting unemployed and there'll be panic. And normally it happens that if one company becomes bankrupt, it has a knock-on impact because a lot of panic spreads. Whenever a company is in a crisis, then there's a lot of rumors and people are making very irrational decisions at that time. So regulators need to know. Of course, researchers, you are researchers. You are writing a project report. You are going to write a thesis. So as a researcher, it's very important for you to know that how this valuation comes in the picture. Yeah, so that is something we shall study. Why do we study this topic? To select the stocks. I just paraphrase this. Is this a security my clients should purchase? If you are a fund manager, you can ask yourself, should I buy Marks and Spencer? Should I sell Marks and Spencer? Should I give a recommendation to my client that if they have it, then hold it, don't sell it yet? Is British Telecom overpriced, underpriced, or fair value? So all these things you want to evaluate first by yourself before you are either doing it on behalf of your clients or you are giving some suggestion to your clients. So in either case, you need to know all these skills. When you will be recruited as a trainee fund manager, then you will be doing this valuation no matter how much you escape from it. Better we do it now. To infer the market expectations. You have a small startup company. Your company is making progress. Your stock price is increasing. You become a public listed company. People buy your shares. People are crazily buying your shares. But being a CFO, you are worried. So there is a queue of people who are desperate to buy your stocks. But you know what? As a finance person, you should be worried. Would you be able to meet their expectations in the future? What if you break their dreams? They would leave you and the company goes down. If your company's stock is consistently undervalued, you have a reason to be worried. Why is the market treating you unfairly? You are capable of a higher value. Your value should be this much, but the stock is going down. Why the market is treating you unfairly? The question is, how do you know that what you deserve? How much the stocks of your company, how much stock price of your company deserve to be? This you find out with the help of valuation. You should be able to evaluate your stock, the fair value, and then you compare the reality. So that's why in the equity valuation, you reach, you want to find the theoretical, we also call it normal or equilibrium, or we also call it notional stock price. So that you see the theory and then you compare with the reality. If after learning the valuation techniques, which hopefully you will learn today, you find out that your stock should be 56 euros. And you find that the market price of your stock is 60. Hence, you are overvalued. Your stock is overvalued. So these kind of, or if you are low, if you are 50, it means that the stock is undervalued. Very rarely, if the markets are perfectly, how to say it, completely perfect, they are perfectly competitive market, there's no information gap, then the theoretical price should exactly be equal to the real price. But the fact is that the reality always differs from the perception. This is the perceived price. Okay, one more name. This is also perceived price, 60. But this is the reality. This is the reality. And reality cannot be same as perception consistently. Maybe for a change, they could be same. But that would be a very transitory moment. That would be very small time period. More often than not, they are not same consistently. Okay. The third thing is that You want to, as and this third point is more relevant. If you are a corporate finance manager, your main business is not finance, but let's say you are a CFO of some engineering company, okay? And you are going to make some event. The event is that either you want to start a new project, you want to make a new product mix, you want to acquire a company, and you want to find out that how this event would change the investors' perceptions and how they react to it. If you tomorrow you disclose a piece of news, Walmart, for example, we can give the example because that's a city company. If they make a decision that in the next 5 years, they would be spending 50 million euros on R&D, then you are interested to know how the investors are reacting to it. The short-term investors would react differently. The long-term investors would react differently. If you are an individual investor, you only have some saving and you buy a few stocks, you react differently. If you are an institutional investor, if you are a big mutual fund who bought Walmart stock, you react differently. If you are an individual investor, but you don't invest directly, but through the mutual fund, you react differently. So there are all kind of mixed reactions. And as a corporate finance manager, it's very important for you to know that how the market would hopefully, you can't make, this is not a prophecy. You can only make some kind of educated guess that how you think people would react. People and institutions, they would react to this change. Is it going to be a merger, acquisitions, divestiture, spin-offs, management buyout, leverage buyouts? These are some of the events which happen in the history during the lifetime, the life cycle of the company, okay? Merger is that when two companies, A company and B company, they come together, okay? And they become one company called A plus B, okay? Acquisition is also the same equation, but there's a difference between merger and acquisition. The merger is more like friendly, more mutual. You agree to merge. Acquisition is more what I call as a predatory behavior. You are a financial predator. You want to buy, you want to acquire. You are a financial emperor. You want to increase your empire, basically. The other person is not willing to sell, but you want to buy. And you do it, you enforce yourself. So there is an element of aggression when it comes to this acquisitions, but the mergers are more friendly. Like for example, the AOL and Time Warner, that was a merger because both companies were very big. They couldn't fight. Okay. Again, it would never happen, but if Coke and Pepsi tomorrow, they would merge. They may merge, but I think none of them is in a position to acquire the other. Okay. You have the divestiture when you leave your stocks. So you have invested somewhere, but you want to take your money out because you think that you have spent a lot of money and a lot of time with this company. It's time to pay goodbye. You bid goodbye to the company and you leave it, divestiture. Warren Buffett is very famous for these. He has a kind of investment cycle that he sticks with the company, but after some time he leaves it. Okay, we did a project last year for a local fund company, and that fund company has a rule that they invest not more than 7 years in a company. So my students last year, what they were doing, they were finding the alternative companies for that mutual this fund company that, hey, now because your 7-year period is going to be over, so what are the next companies where you should invest your wealth? So and the one group of students was saying that what should be the fair value at which they should buy. So these kind of things are events in the company's life cycle. Spin-off, spin-off, have you heard about it? The spin-off is that you have a big company, you split, not split it, but you start a new project out of it. And then the project gains momentum and that becomes an independent entity. That becomes a spin out of it. Okay. For example, we run, let's say, let's assume that we are a financial consultancy firm. Okay. And then I recruit, you all are finance guy. Then after some time, I recruit 2 lawyers in a team. And on some low scale, we also start providing some legal consultancy to corporates as well. But still our main business is the financial consultancy. But at some stage, the legal business becomes so big that we have to open a new concern, which is exclusively the legal consultancy company. So that's a spin-off. Management buyout is that, and this happens is going down, very much down. Then there is a fear that some outside company would buy it. And when they buy it, what would the first thing they do? They fire the management. And the managers are scared of losing their jobs. What they do, they know that because the company's stock is losing, then they start collecting their own money in their pockets. And then they buy the company by themselves. And then delist it from the stock exchange and make it a private company. So from public to private. And if they don't have money, even more dangerously, they can borrow money from the banks or even whichever source. And then they finance this purchase of own company with the help of debt. And then we call it LBO. LBO means leveraged buyout. So management can also do the leveraged buyout. Leverage means, in finance, leverage means debt, when you borrow. So if the company's stock is going down, your stock used to sell for 100 euros, is going down to 20. Oh my gosh, there is a danger that somebody would acquire you. If he acquires, you would lose job. So what you do, you start buying your own company's stocks. And you have bought almost, let's say 50% of the company. Still 50% is left. And you don't have money. You means the managers. Then you borrow from the external sources. And by combining the own equity and the borrowed capital, you are buying your own firm. So we can call it MBO, but if it is largely financed by debt, then we call it LBO. Okay? And the leverage capitalization is that when a company is heavily moving away from equity to debt, okay? But even at that time, the company issues some new stock, maybe to the existing shareholders. That is called leverage recapitalization. That even though, so you are basically borrowing and buying the equity. So these are the big events in the life cycle of a company. And when these things happen, they have big impact on the company's stock price. We need to find in the life event. And with that, because you the borrowed capital. Act with all that. that and the fine primo. Can you fair price of company Y? What can be the fair price? If I have to offer, if I tender an offer to this company Y, how much you think I should offer them? Because I don't know. Okay, so in that case, you can also act as a consultant who gives a fairness opinion, right? Like I remember 3 years ago, there's a small startup company based in Uvascula. They came to us and they asked me that, hey, you know what, I want to apply for funding, but I don't know how much money I should apply for, because I don't know what's the value of my company, because it was all based on intangible assets, except for a chair and a table and a few computers and maybe some cutlery. They have no tangible asset. It's all intangible assets. So they wanted to get themselves evaluated. That number one, they can ask for the funding, and secondly, if they have to sell themselves, how much money they should expect to get. So these things requires valuation. The next point, to evaluate the business strategies and models as a corporate finance manager or even as a non-finance manager, you are interested to know that when you change your business strategy, business model, tactics, strategy, how this would have an impact on the valuation of the company. Even a marketing manager can be very interested in the valuation, because you are making a complete market, you have complete market, new market plan altogether. And when you make such a big change, the investors would react. You are you can be a researcher in the field of organizational sciences, nothing to do with finance. And then you realize that the company's organizational structure is now getting from one board, a one-tier board, to two-tier board. Like, for example, in the Anglo-Saxon countries, like English-speaking countries, you have one board. But in European companies, mainly the German companies, there are two tiers of board. So there's not one board, but two levels of board. And when you make this kind of change, how the investors would react to it, you are interested to know. And then, of course, valuation is a mean of communication as well. Like, for example, I said that the company's stock is worth 50 through the valuation methods, and the stock is 60. I don't have to tell you anything more. You know that I have communicated to you that the company's stock is overvalued, or it can be undervalued as well. So basically, these different things we do with the help of valuation, but that's a theory, that's the idea behind it. And the first model that we apply that we do for the valuation is called Dividend, discounted dividend model, or dividend discount model, DDM of valuation. In this model, we make a forecast of the future cash flows. And I think I mentioned a few times that the time is very important in finance. Your current action largely depends upon what has happened in the history. And your current action would have an impact on the future outcome. So there is a very clear linkage. Today, you don't take a random decision. You always say, hey, I'm very experienced. When you use the word, hey, I'm very experienced, what does it mean? It means you have seen historically some happenings and their outcomes. That can make you wiser. And based on your wisdom, you take a decision for the future. It can go horribly wrong, but at least you have some backup to support your decision. So therefore, there is a very clear synchronization between the past, present, and the future. That's why time plays a very important role in finance. So in what we do in this model, we make a forecast of some cash flows, and then we discount them, okay? And then we can find out that how much this stock is worth of. For example, the two things which we use, I'll explain it with an example, but very quickly I want to discuss with you the two things which are very important is that you want to make a forecast of the cash flows, that how much money this project would generate. For example, you start a new R&D project and you make an estimate that in the first year we'll make $100 million. In the second year, we make 125 million. Then in the third year, maybe some cash flow go down because then the project machinery will become a little bit old. So we are expected to earn 75 million and so on and so forth. And the project would finish in 3 years. And you find out that this 300. Can I say today, on 22nd of September 2020, that 21, 22, 23, by the end of year 23, I would be having additional cash flow of 300 million? Of course not. Why not?
Because of the environment is changing.
The environment is
changing.
So can I say this phrase you used, that the whole business environment is changing? Can I call that there is a risk behind this cash flows? So there's a risk element. And how do I capture this element of risk? We use a term called R, which is called discount rate. I will discuss with you where this comes from. So we make an estimate of discount rate. If your cash flows are risky, your discount rate is more. If your cash flows are less risky, let's say you are talking about this scene, this scenario, and your company is a utility company. Let's say you provide electricity. I make it even simpler. You're the only supplier of electricity in the city. People would be using electricity, hopefully, next 3 years. The element of risk is comparatively less. And in the second situation, you are a company which is totally based in the, let's say, some very technical technology sector, or you are a completely R&D type of firm, a biotech company, a technology company, research and development company, or consultancy. In that case, this forecast of the future cash flows would be risky, comparatively riskier. And remember, these cash flows, whether we go for this project or we don't go for this project, this decision we are making today. So we will not wait till the end of the project and then lick the dust and have the bad consequences and then learn from. By the time the company would be bankrupted. We want to make these estimates now. So what we do, we want to find the present value of the future cash flow. So we want to find how, we want to make an educated guess at how the future would look today, 3 years from now. The rate of discount is calculated from many, in many ways, and I would come very shortly to that point. But the rate of discount includes all the risk factors which you can see. I'm sure that in 2019, when the corporate finance managers were counting this R, they never added COVID-19 risk. Because you always calculate this risk factor based on how far your mind can go, how far you can perceive. So these are basically the risk factor which you can think about, but there are some things which are unthinkable. They can come from anywhere by surprise. So that is something. It also, maybe some managers did, don't know, but it depends upon how far-sighted you are. I can show you an example here. This one. For example, you make an investment of 100,000, yeah? Can you see here? So there is a cash outflow, which means you made an investment, 100,000, and you make a forecast. So this is when you make this investment, will it be year 1, 2, 3, 4, 5? What should I call it when you make investment? How do you put numerically present? If you have to show present in numbers, what number would you put for present right now? If I say that, express the time today, now, right now, with the help of a numerical, what number would you put? 0. Now we are in time 0. After 1 year, year 1 or period 1, 2 years, 2, 3 years. So if you want to express present in finance, we always put T0, for example, time 0, present. If I put T minus 1, this is a period in the past, 1 previous period. And if I put T1, it's a 1 future period. Make sense? Okay, now, imagine you are going to make a decision to invest or not to invest, and you know for sure that this investment will cost you 100,000. Look at the cursor here. And you have a forecast. Of course, this is not a fluke. This forecast is also based on some calculation, some knowledge, okay? Valuation, for example. And you evaluate that next year, the project's cash flow will be 25,000, 25,000. Next 5 years, you will get 25,000 each year. And let's imagine, for the sake of simplicity or for the sake of stupidity, that people who run this project have no knowledge about finance. I mean, they have very superficial knowledge of finance. They're not very experts like you guys are. What is the sum of all the cash inflows? $25,000 first year, third year, fourth year, fifth year, yeah? Yeah. So you will be adding all the cash flow. So we put this sign, Greek letter sigma, which means sum. And you have cash flow of all the time period where T varies from 1 to 5, because we have 5-year period. So you are making 5 additions. 25 plus 25 plus 25 plus 25 plus 25. How many times? Minimum 1, maximum 5. How much it is? Can you roughly calculate how much is this? How much is the cash inflows? How much cash flow you get? 125,000. That's the money coming in, yeah? How much is money going out? How much is money going out? 100,000, yeah? Is it a surplus or a deficit? Is it surplus or deficit? Surplus. How much? Should we go for this project? We should, but this decision would be taken by the person who is not having knowledge in finance. Being a student of finance, you will learn that, you know what? A bird in hand is worth 2 in the bushes. Have you heard this phrase, proverb? Okay. We never know what you get after 1 year. We never know what we get. We can only make an estimate. And your estimate would be reality if there's no risk. And there is a difference between the reality and the estimate if there is a risk. And risk come from where? Risk come from the external market situation. Okay, I make it simple. Let's say you make a good estimate that you read some economist report, you read Bank of Finland's report, and you read some good credible sources, and you find out that there's a fear that next 5 years inflation would be 3%. Is inflation a risk for you? Of course, your cash flow would, the real value will go down. And then you also find out that this cash flow is basically coming from USA. And they will pay you in American dollars. Okay? And when you convert the American dollars to the euros, what will happen? The euro's value will go down in the future. And the euro will devaluate by 5%. Depreciate, sorry, not devaluate. Depreciate by 5%. It means when you convert your dollars to euros, you will get 5% less. And then you also make some other estimates that there's some other risk. So altogether, miscellaneous, let's call it others, 2%. And with your credible knowledge, with your credible estimation, you find out that there is a rate of discount, 10%. And this is the rate of discount, R. Okay, and then what you do here? I made this Excel calculations formulation, and I just put it, this yellow part. If you want, I can make it a bit larger, zoom in. When you know that the next year, next 5 years, the rate of discount would remain 10%. First of all, this is a bad assumption because the risk will never remain constant each year. But let's say at least it's better than ignoring it. So you find out that 10% would remain the risk factor for each year. And guess what happens? I made this Excel formula. 1 divided by this whole thing will be 0.909 euro. So only 90.9 cents. The same euro after 2 years would be about 82.6 cents because of this risk factor. So if somebody gave you choice, hey, do you want to take a euro now or a euro later? You say, give me euro now, because after 2 years, this euro would be worth 82.6. So obviously, yeah. And after 3 years, you can see here, this euro would be about 75 cents. After 4 years, it'll be about 68 cents. And after 5 years, it'll be about 62 cents. And guess what I did? I multiply each cash flow with this new value of money. And when I sum up, it comes to be 94,750, not 150,000. It means that the sum of all the cash flows which you get after discount is not 125,000, it's 94,750. So if your sum of cash flow is less than what you invest, it's a bad project. Don't go for it. So basically, how we make a formulation, sigma, I can write it here. If you don't have the financial expertise, then you will write a formula like this. But if you have it, then you will discount it with 1 plus r to the power of 5, because we have 5 periods. Yeah, period 1, period 2, period 3. I should call it T actually. T would change. The first year you put to the power of 1, second year end you put to the power of 2, like here, third year to the power of 3, power of 4, power of 5. And when you want to make this kind of general formula, it becomes sigma cash flow T move from 1 to n, and then here we put 1 plus r to the power of n or whatever. Yeah, so that's how we make this kind of. This is the role of discount factor. It's very important in finance. And this is how you do the valuation of the company's stock. Any questions or anything you want to ask? Yeah? No? We'll take a 5-minute short break. And next, when you come back after this 5 minutes break, I will discuss with you where this discount rate comes from, where you will be getting this discount rate. Today, I will tell you how we calculate this discount rate. Okay? So after we meet 5 minutes break, then we shall discuss where this R comes from. Take a quick short break. And I can, a bit of theory we had, we know the rationale, we know that why we calculate R, and now the next thing is to know how we calculate R, how we get it from, where do we get it from. If you are, let's say, if this cash flow, which I mentioned, that 25,000, so on, let's say you invest in the Bank of Finland's treasury. What's the risk? Very less, almost negligible. I would say 0. So in that case, what happened is that the risk factor which you use, R, is basically, you can get it from, if you go to Bank of Finland's website and you type in treasury bond, 10-year treasury bond issued by Bank of Finland. In that case, that would be your relevant rate of discount, because that incorporates all the potential risk factor. And as you mentioned, somebody mentioned it will be very less. Yeah, did you mention here? That it will be very less, or who mentioned? Well, good, yeah, very small. So then the R may be something, or maybe 0.5% or 0.7%, very less risk factor. But if you are not a state, but some enterprise, private enterprise, then definitely we need to keep into account that, hey, you know what, there are market risk and so on and so forth. For the non-state enterprises, the risk factor generally, this R come from, of course we can calculate like this, as I mentioned, that okay, inflation risk is 5%, depreciation risk is 3%, but that may be a bit complicated. We have some formulations to support our risk calculation. The first source of risk factor calculation is given by our beloved capital asset pricing model. Those people who have studied finance, financial management in the past, have you all actually? Or how many of you are studying financial management now? Okay, those who have studied before, they know that we have a capital asset pricing model. And what I did, I copied the same spreadsheet from the financial management workspace. So it's there, don't worry. But what I did, I got, and the formula, first of all, the formula of the capital asset pricing model is that if you want to have the minimum return on equity, the threshold, the risk factor, which you must give to your shareholders, it should be equal to return on, let's say, equity is risk-free rate plus beta. Beta is the measure of systematic risk, and I shall do it. And guess what? I deliberately chose FinAir because that spreadsheet will help you to do the calculations even for the project. I have almost spreadsheet for every big company, at least in Finland, but I chose FinAir because FinAir is the one you are going to calculate anyways. So that spreadsheet will help you. And this is equal to RM, the market return, minus risk-free rate. And that would give you how much is the investment, how much is the minimum expectation which you must meet of investors. And that we use as a R, as a risk factor. Now, question is, how do you calculate it? Well, not a big deal. We go to our Optima workspace spreadsheets, and there is a FinAir risk return calculation, something like that. And after I have it, it looks like this. But let me see if it is visible to everybody, right? And new share the spreadsheet. Where is the spreadsheet? This is a spreadsheet here. Here we are. So what we do here, that we have, for example, I calculated it last semester. So we have from 3rd of March 2020, we have the data of FinAir. Starting from 4th of February 2000. So we have 20 years data, basically, which is enough, rather more than enough. And then we have the stock prices, the stock price of FinAir. The closing price is what we take. And then we compare FinAir with the OMXH Helsinki 25. This is the index. You know this index? This is the market return, basically, the market index. Because you want to compare your company's performance with vis-a-vis the market performance. So we assume that FinAir return is a function of the market return. And market in this case is OMXH Helsinki 25 index. And then guess what we do? We are calculating two things. We calculate the FinAir return, and you can see that the formula in this, it's current price, like for example, today's price divide by yesterday's price, close the brackets, both sides, divide by yesterday's price. And then we calculate the return for the full period. You just have to click this thing, and then it comes for all the period. The same way, we have the index value, but we also calculate the index return. We have the index return. Once again, the current value, first of all, bracket starts. If you don't put the brackets, it will be a big mistake, believe me. So use the brackets very carefully, because if you don't put the bracket and you write like this, R2 minus R3 divided by R3, basically this will be cancelled, so you'll have R2 minus 1, which is totally wrong. So put the brackets carefully. And when you put the brackets, there are many more things in this spreadsheet. I will not discuss them yet. But the main point is that when you have the company's return and the market return, you want to see how much risk is there. Where does risk come from? And here you can see that I use the slope function. Slope function L2 to L4645. So we have 4,645 observations in 20 years. And L column, by the way, was your Finnair's return, separated by semicolon, S2 to S4645. And S column, by the way, is your company, the market return. In this case, market is OMXH25. And it comes to be 0.24. Now, 0.24 shows that the market risk impacts the Finnair stock return by 0.24 coefficient. In other words, if during the 20-year period, if market goes up by 1%, Finnair's stock return will go up by 1%. So it's not very, so Finnair has not been too much influenced by the market. And if market goes down by 1%, the Finnair stock return will go up down by 0.24%. So it shows how sensitive is Finnair to the market changes. If you are a risk lover investor, then Finnair is not your choice, because then you want to see the big beta, more than 1. And if your coefficient is 0.24, which is very less, so it means that Finnair has been an obvious choice, a natural choice for risk hater investor, because 0.24 is not a big coefficient. There are companies, especially in the growth sector, whose beta could be 1.5, 1.6, even more than 2. So Finnair has always been a kind of safe investment. There has been less market exposure or risk to Finnair. Now, the real thing which is more relevant after you calculate this thing, 0.24, we check, well, I checked it last time. At that time, the 10-year bond rate was minus 0.3%. So it was because the interest rates were low. And then we calculate this thing. UT1, risk-free rate, plus beta, U16, which is beta, we just calculated 0.24. Market return, which is a VM column. I have calculated it here. I can show you VM. Where is VM? Sorry, V what something? Yeah, V market return. Yeah, which is here. Yeah, 12.545. So the average market return. So the index has grown 12.545 a year in the last 20 years. So when you put all these values together in this formula, which I wrote here, then you are able to get expected return. Yeah, okay, sorry. Yeah, so V12 is this. This is V12, which is total return of the market, I guess. Yeah, minus U21, which is again the risk-free rate. Yeah, so this is the, you can see 12.545 is the market's value, market return. So you can see that everything is now visible in the formula. And compare this formula with this model, CAPM model. So the formula is U21, risk-free rate, no risk, 10-year bond, plus beta, which you calculate by slope function, multiply by the market return, which is 12.545 minus risk-free rate again. And that gives us how much? That gives us 2.75%. It means that if I want to calculate the future cash flow generated by FinAir, I would discount them by which R? So remember the formula? The formula of, this is the formula. The cash flow divided by 1 plus R and times number of time periods. Okay, so in this case, my R would be 2.75%. So I know where to get this R from. Good or bad? So we learned a theory, but we also saw the proof where these numbers in the theory come from. Any question, please ask me. Then second, after some time, I'll go and show you the next source of risk factor, or the discount factor rather.
And how do I calculate the expected return on Market's portfolio?
Well, it's we use capital asset pricing model, and this is the formula we use. So this is the risk, exactly, look at this, risk-free rate plus beta times RM minus RF.
Yeah, the
RM.
Yeah, exactly.
Okay, no worries. Okay, this is the market return, and you can see here, that's a good point. I think I should have told you. Have a look at this formula. This is the average daily. So this is the rate. Because I'm recording it, so you don't have to write it. Yeah, just have a look at the screen. The average daily market return of the whole market, the index, for 20 years is this. So basically every day, the Helsinki index has been growing at 0.0324% for 20 years. But this growth has been every day. But in finance, we try to make it annual increase, not daily increase. Daily makes a little bit complicated. So what I do here, I make it annualized. I make it annual. Annual means yearly, yeah? So what I do, the formula is 1 plus daily return, yeah, to the power of 365, because we have 365 days, minus 1, that gives us. So if the market grows every day at this rate, then for the whole year, the market grows at this rate. Okay? And the same way, wait a sec, the same way you can calculate how much FinAir has been growing on daily basis. Where is that? Where is FinAir's daily growth? Maybe it's here actually. Yeah, here we go. So FinAir everyday basis for 20 years, FinAir has been growing at 0.0247%. But when I annualize it, FinAir grows at 9.4. So for 20 years, FinAir has been growing every year. So every year, year 1, year 2, year 3, year 4, counted 20, but every year, the average increase has been 9.422% of FinAir stock. Okay, so that's why we always convert daily increase to the annualized return. So it makes things easy. Make sense? Good. Now we leave this spreadsheet for some time. We know that in case of FinAir, when you will be estimating the future cash flow of FinAir, you can use, for example, 2.75, or you can do one big favor to me, in fact, because this spreadsheet I calculated, the latest day at that time was 3rd of March. So if you can add more days to it, and then you can make it even more contemporary. All right, try. If it works, it works. Even though a few months in 20 years time is adding a few buckets of water to the sea. It doesn't really change much. Or maybe it will, because remember 3rd of March, the COVID impact is not included. So I can say that this data that I have, it does not include the COVID effect. But if you want to learn COVID effect, then I think it can be a very good thesis topic that you have data of some companies. You first calculate all the things up to beginning of the year 2020, and then you add more data and make it up to September, October, whatever, and then see how things change. And that change you can contribute largely to COVID-19. So a very good thesis topic could be impact of COVID-19 on the Finnish stock market performance and empirical evidence. Think about it. But anyways, I leave this spreadsheet for some time because otherwise I will not be able to finish this topic. Okay. I have a new share now. And yeah, we carry on. The next formula, if your company has a lot of debt, I'm sure Finnair has a lot of debt. Then if you only make the risk factor based on the first model, first formula, then you are ignoring the second category of investors. And who are they? Debt holders. Debt holders. Are you with me? Debt holders. So what we do in that case, if your company is like IT, biotech, media, you hardly have debt. Well, not that you don't want it, but nobody gives you. Because it's a very risky company for the lender to give you loan, okay? But if you are a company with lots of tangible assets like Finnair, if you have a long history like Finnair, if you have very good cash flows in the past like Finnair, I would say that Finnair is a good candidate of debt. And if you have a lot of state backing, remember the Finnish state is a big investor, the biggest investor in Finnair, right? So in these cases, it's more credible and the companies would like to give debt. The banks, the financial institution would be more generous. It means that based on my hunch, Finnair is a good borrower also. Okay, so in that case, if I only use the discount rate given by CAPM, Capital Asset Pricing Model, maybe the picture is not complete. The picture should be complete with the help of debt. And when I do this, when I include debt, of course I have one part, which is equity, fine. But if I want to bring the bigger picture into discussion, then I will be using the rate of discount as WACC. WACC, which is equal to weighted average cost of capital. Weighted average cost of capital includes both debt and equity. Okay, and how we calculate it? We multiply the weight of equity with the return on equity. Like, and this comes from where? This is the same which come from here, from CAPM, yeah? What we have is RE, so weighted, so we have weight of equity, how much ratio of debt you have in the company, multiply by RE plus weight of debt I have to push it. And 1 minus corporate tax multiply by the debt rate, the rate at which you borrow. Okay, this part looks a bit different from this. This is quite simple. Rate of equity, cost of equity. Rate of debt, cost of debt. But this 1 minus TC is something extra. Can somebody give me the reason for it? Why I have 1 minus TC in between? Any idea? Any thoughts? Because debt payments, which is interest, is exempted from tax. Okay, when you're a company, what do you pay first? Do you pay interest or tax? Let's say you are a company and you pay now, you start making payments. You have revenue, now you make payments. What do you pay first? Do you pay interest first or do you pay the corporate tax first? What do you pay first? Interest. It means that people who get payment on debt, that is interest, they are not taxed by the state, basically. If you want, I can show you very quickly, because people who haven't seen this thing, they might be a bit nervous that what I'm doing here. So what I do here, if I just check FinAir annual report, for example, 2019, not sure if I get it, but let's see. Yeah, this one. Maybe I zoom in a wee bit, and I also make sure that I'm able to share it with you, because otherwise, here we are, I guess. Oh, this one. Oh, okay, this one. Yeah. And I also zoom in so that you can see it. Okay, ladies and gentlemen, see here. This is the, is it visible or should I zoom in more? A bit more, yeah. I know, it's not very clear. So you can see here, this is the interest which FinAir pays. And you can see the sign is minus, so 83.6 million euros FinAir has paid as interest. So it pays, it means people who got this interest, the bankers, let's say, they have not been taxed, basically. So they get the cash flow tax exempted, because FinAir will pay the tax here. Because FinAir income tax 18.4 million euros last year. And this tax was paid after you pay interest. Whereas the money which belongs to shareholders, this much, this is calculated after tax. So the shareholder get the money after tax, but the debt holders gets the cash flow before tax. You get my point? It means that the debt holder have not got the tax burden. That's why we put 1 minus TC. Look, for example, let's say the cost of debt is 5%. Yeah, the cost of debt is 5%, and the company is paying income tax 25%. So basically, 1 minus 0.25, 75% of 5% is 3.75. So basically, the company is not paying 5%, but company is actually paying, in reality, 3.75%. Because that money is saved from tax person. So basically, the company is saving 1.25% from the tax bureau and giving it to the debt holders. Because if this money was not debt, it would have been taxed. Because it is not taxed, because it is paid before tax is calculated, hence this money the company has taken from the jaws of taxman and distributed to its shareholders, debt holders, sorry. Look, debt holders are investors of the company. To be honest, if I'm a very selfish person, I will give money not to taxman, but to my investors. Do you get my point? If I give money, I'm thinking from very immoral, selfish, whatever you call it. If I pay money to taxman, there is no reciprocity. I don't get proportional benefit. I mean, the state of Finland will not allow me to drive car whichever way I want, and then they catch me and say, hey, you know who you're talking to? I pay tax. Okay, who cares? But if I give this money to my investor, what do I win? I win the reputation. I win the faith. I win credibility, fidelity. So therefore, basically, if the tax rate is 5%, sorry, the interest is 5%, and the state of Finland is imposing 25% tax on my company, I'm not paying actually 5%, I'm paying 3.75%. That's why this formula comes here. Why? Because interest is paid before tax. Here, no such formula comes because you pay profit to shareholders after you pay tax. So there's a pre and post thing you have to keep in mind. Okay. Now, for example, we calculated last time, was it 2.57% RE in the spreadsheet? How much you saw the return on? 2.57, I think. 2.75. Okay, let's call it 2.75. How much is RD? How much interest Finland the Finnair pays? Well, it pays 83.6 million, yeah? And how much? So it means that 83.6 million. And how much is debt? If you want to see the debt, you have to go to balance sheet of the company. And if I create the whole of liabilities, basically, it comes to be 2911.5, yeah? So that's my total liabilities, yeah? 2911.5. Can somebody divide 83.6 by 2911.5? Zero point. So basically this is 0.02, 0.0, 0.03, 0.03. Can you call it 3% then? Right? So now you have RE information. Sorry, where is this? Yeah, RE, you have RD. How much debt and equity you have, you need to know what percentage you have equity and what percentage you have debt. The company's total value is the company's total value is 3877.9. 3877.9. And how much is the total equity of the company or liabilities, for example? 29. Total liabilities are 2911.5. So can somebody divide 2911.5 with 3877.9? Can you find it? 75. So can we say that the weight of debt is 0.75 Hence, the weight of equity is 0.25. So 75% debt, 25% equity. Yeah, makes sense? Are we missing something? Actually, we are missing this thing. What? How much tax Finnair pays? We need to go back to the income statement. How much is the profit before tax here? Can somebody point out how much is the profit before tax? Have a look, folks. How much is the profit before tax? How much is the profit before tax? 93. How much tax? How much tax is Finnair paying? 18.4. Don't have to consider the minus sign. What percentage is this? 19%. Let's call it 20. Yeah, keep it simple. So it means that this is, yeah. So now I'm taking step by step. Weight of equity 0.25 multiplied by return on equity 2.75% plus the weight of debt 0.75, 1 minus 0.20, yeah? Remember this? So basically 80%. And how much is the cost of debt? 3%. And when you do this mathematical calculation, it comes to be 0.6875 plus 80, 0.66, 1.8. Can you do this calculation? Am I right or wrong? Does it come to be altogether? Let's call it 70. So is it around 2.5%? Yeah. Can you please check my calculation is correct? About 2.5%? It means that if I want to, if I don't want to use CAPM only, if I don't want to use only the equity thing, but I want to see the capital thing. Capital includes equity and debt. Then I can use my rate of discount here. Where is that? I rubbed it off. The discount factor as WACC, the weighted average cost of capital, which is 2.5%. Okay, depends. If the companies in the projects were not airline companies, and for example, the IT company, then I will not really bother to calculate WACC. But because as you can see, Finnair is heavily financed by debt, therefore it will be unwise to do the rate of discount based on equity only. So it's good. I advise you to not just use 2.75, this one, but rather use this one, 2.5, which is the WACC, because 75% is the outside capital, not the share capital of Finnair. I had a hunch that Finnair would be heavily financed by external liabilities because Finnair is a good candidate to borrow. It's a regular cash flow, old company, almost monopoly, backing by the state, and lots and lots and lots of tangible assets. So everything is good to be a good borrower.
What if
people in Finland would be complete idiots and want to pay interest costs after tax? Is it possible?
No, it's not possible because it's accounting, by accounting principles, it's wrong.
Okay.
Look at the, okay, I asked you, that's a very important question. What is the definition of a shareholder? Who are the shareholders? Shareholders can be defined in many ways, but I define shareholders as who get leftover. We call them as residual claimants. Residual means leftover. Claimant means those who have leftover claim. So, and leftover from where? You pay for your fuel, you pay for those salaries of your staff, you pay everything, and then you pay debt, interest you pay, and then you pay tax. Whatever is left is shareholders. So you have to minus everything, including interest. No, that would be wrong according to the accounting principles. Of course, I mean, PricewaterhouseCoopers will not sign their statements. They will be penalized. Yeah, they will not even find an auditor to audit their accounts.
This happens in small companies. They pay the tax and then they're, oh fuck, we forgot to pay that.
Then you do the restatement. Sometime I give you an idea. Have you noticed that when you look 2018 report, you also get 2017 report as well? Parallel column. Like you can see here, you always get 2 years column. And it's always different. I tell you why. Because they make some changes. Because there's always, even if you have a very well paid internal auditor, you pay a lot of money to PricewaterhouseCoopers, KPMG, all these people, you know, there's, yeah, EY, E&Y, they always make some minor errors. And then this report goes to the Ministry of Corporate, the Ministry of Companies Affairs or whatever. Then they check, and then they talk to the company and the auditor, hey, you know what, we think that you guys have done a good job accountingly, but according to law, it's wrong. And then they make some restatements, right? So therefore, even if you make a mistake, even if the auditor ignores, hopefully not, there is a still possibility that somebody from the regulator will catch you. And the auditing company would be very angry if it happens, because it's a matter of their reputation. We call them Big Four companies, yeah? Big Four. So they will not be big anymore if it happens every day basis.
We're gonna do this. Maybe, is it possible to drive the auditors to value us bigger?
Yes,
than we
yeah.
are?
Have you seen this article? Wait a sec, I show you something.
Maybe we
Wait a sec. Santu, you asked me a very interesting thing. I don't want to go in that discussion because then I would spend all time in that. Wait a sec, research articles, yeah? And if you read, for example, where is that article? Accounting is broken. Did I share it with you?
Mm-hmm.
down.
It's really down.
Yeah, and then there's one more article by, yeah, Stern Stewart, Accounting is Broken. But there's one more article by Kalpan and something starting, oh, yeah, this one, yeah. I mean, if you read this article, Santu, I don't know whether you chose it or not, but it doesn't matter. Read this article. It's about Enron, that how the bribery was going openly, not only to the auditors, but also to the politicians. How the politicians were bribed, how the auditing companies were bribed, and so on and so forth. Yeah, and if you see some of my papers here, where am I? Ah, here we go. Then I have done some research about the and how this corruption goes with the Indian companies. So I've done a lot of research about the Indian companies' corruption here. So yes, you will find a lot of, and you're right, these things do happen. But you have to be very smart to do it. You really have to be a smart person, best brain.
Since we're talking about the articles, what do we really have to do when it comes to literature review? Like what is it like?
The literature review?
Yeah, like the pros and cons. Like,
Yeah, that's a good question, even though it's completely off the target.
yeah.
But I tell you something. Look, imagine I want to start a research. Let's say Santu is intrigued by the corruption, the company corruption. All these points, they motivate him. So his idea, his research problem, which he gets, is that can we bribe the accountants and the auditors? Or basically, he's trying to investigate how much is there something called corporate corruption? Yeah, this is the research problem. But then he should not investigate something which by chance has been investigated exactly before. You don't have to reinvent the wheel every day. Then we want to learn from the old gurus, right? And then we have some research objective, but how we make that research objective, which he has, how we make it more actionable, right? Then we do the review of literature. We learn which ideas have been debated before, which we shouldn't, because it has been a consensus already, or where there's a gray area which needs more discussion, right? And then through the literature review, you sharpen your research questions. You make them more actionable. Because if you don't study the literature of the previous people, you will be living in a fantasy world and you will think, oh yes, everything I think is researchable. No, it's not. You don't want to do the same research time and again, okay? And you also want to see some realities. And you also want to become intelligent. You want to get some more ideas as well. You polish your research problem objective through literature review. And then you make your hypothesis. Hypothesis means which you will be exactly studying in the context of your own data. So we go from ideas to actions. We have some ideas, we polish them with the help of literature review, and then we make our actionable hypothesis. Hypothesis which you will be discussing with the help of your own data. And then you collect the data, test them, interview, whatever, and then prove that whether your assumptions were right or wrong. Make sense? Literature review gives you better ideas, more ideas. You stay away from those ideas which have been researched before so many times. So you can polish yourself, your ideas, in the light of literature, and also see which technique you should apply, which data, which variable you take, which you don't take. Okay? So you make your research more sharp. Otherwise, if you don't have the literature, it's just like a prophecy, you know, just making some random thoughts. Okay, we go to our slides back, which are here. I have to share my slides once again with you. Are they here? Oh, no, this one. Okay. Okay. So now we know, right, that how do we get this all right. Now what I do, I give you another 5 minutes break. And after we are done with this, I will discuss some more theories, a few more slides, and then we shall be making a real life valuation of this company called GlaxoSmithKline. I deliberately chose GlaxoSmithKline, not Finnair, because otherwise I would do the whole project. What would you guys do? Okay, so take a 5 minutes break, and then we shall make a real valuation of GlaxoSmithKline. And I'm taking a pause so you guys can have a short break and come back soon. I'm resuming the recording now. We take one quick example, how to do the valuation by using the dividend discount model, DDM. Remember that model that we have been discussing so far is called dividend discount model, DDM. Take an example. There is a GM, General Motor, which is listed in New York Stock Exchange. It is planning to give a dividend of $2 next year. And you are expecting, as an analyst, that next year, the price of the GM will go up to $58. And let's say the required rate of discount, this R thing, which is, we spend a lot of time on calculating R today, is 10%. What is your estimate of the value of GM stock? And the formula you use is that if you want to V0 mean the present value, remember wherever you have see this word, not word, but letter 0 in the subscript, it means the present value is equal to dividend that you want to give next year, plus if you have to buy the stock, you will be paying $58. And divide by 1 plus R. Remember, in both cases, the power of period is 1, because we are only calculating for 1 year. Are you with me? That is why the power is only 1. If this estimate, imagine, I slightly change the wording. It says the GM is likely to pay a dividend of $2 in 2 years, and the stock price in 2 years will be 58. Then the power will be 2. The exponent will be 2, because we are only talking about 1 year. So therefore, the power is 1. And next year, if you have GM, if you buy GM today, you will have 2 cash flows next year, will you? If you buy GM today, how many cash flows will you get next year? If the report of analyst turns true, well, you will get dividend, $2, plus if you sell your stock, you get 58. Make sense? It means you will have 2 cash flows, $2 dividend plus 58, and then you divide them. So this becomes dividend in time 1, price in time 1, 1 plus rate of discount to the power of 1, and that would give you this V0 will give you the present. What should be the fair price? What should be the fair price of GM? And when you do these calculations, it comes to be $54.55. It means the fair price, the theoretical price, the notional price, the perceived price, the equilibrium price of GM is 54.55 cents. And this is not the price exactly in the market. And what you do, immediately you check the price outside. And if you compare that the actual market price is below 54.55, it means GM is undervalued. And if the market price at that time is more than 54.55, then you can say that GM is overvalued. Very rarely they would be same. So you can make some kind of judgment about it. Okay. One more question. The current stock price of Daimler Chrysler is $44.70. and you are so this is the current price now. So this is V0 already. So you have to be very careful who's who. The current price is 44.70. Last example, it was expected price. So that was P1, the price next year. Remember, 1 year from now, period one, yeah? In this case, this is already the current price, 44.70. You expect a dividend. So this is V0 according to formula. This is V0, this thing. This is D1, okay? And you forecast that the price next year is 49. What is the rate of discount then? So basically what you have is, if I make it clean. So the current price, the formula is this, D1 plus P1 divided by 1 plus R to the power of 1 because it's only one period. The current price is 44.70. The next year dividend is 2.08. The expected stock price is going to be 49, but we don't know the rate of discount. Well, you can calculate by yourself. Just use the equation, you know, the solving of equation, and you find that R comes to be 14.27%. It means the risk from now to next year is 14.27%. So this is not a safe cash flow. This is a risky cash flow. And the risk which you should discount, the future cash flow is 14.27%. I think it's straightforward. And there are a few sums. One more before I take you to the GlaxoSmithKline. For the next 5 years, the annual dividend of stock are expected to be 2.10, 2.20, 3.50, 3.7. Now we have 5-year period. And you have D1, D2, D3, D4, D5. Do you? In addition, the stock price is expected to be $40 in 5 years. So it means your P5, you know, the price in the 5th year is also 40. And the cost of equity is 10%. So it means in this example, you're only taking 10% as a rate of discount. So maybe you want to go with CAPM, okay? The only rate of discount given is 10%. And then you can find out the present value. What should be the current price? What should be the current value of your stock? And basically you do this thing, this thing. In the first year, you only get dividend, yeah? In the second year, you only get dividend. Third year, you get dividend. Fourth year, you get dividend. Fifth year, you get two things. You get dividend plus you get the value of your stock. That is why you can see that there are to the power of 5 here, to the power of 5 here as well. Because you have two cash inflows, but not in the first year, not in the second year, not before 5th year. And when you find out, it comes out to be $34.76. So the formulation is very simple, basically. There's nothing very confusing. So, you know, yeah. Time to take you to GlaxoSmithKline. And I have done, this is exactly I expect from you, that you will make almost a ditto of this spreadsheet for KLM and Finnair. Finnair, I think the spreadsheet is almost ready for you already. You know, it's in the system, so maybe you have to do something for KLM. But basically same thing. I take you to I take you to wait a second. It's very complicated when you have so many windows. Yeah, study material, spreadsheets, and in the spreadsheets we have valuation model spreadsheet here, and I open it. Valuation model. I save it. I hope it shows up. Yeah, it should. Yeah, it shows up. And I share this screen with you so that you don't miss out. Valuation model and share screen. There we go. So now we are safe. I slightly zoom in. This is the data I got yesterday. We have a company called GlaxoSmithKline. And it's better that I also show you how you can download this data by yourself. I take you to this website, which I use quite extensively. I think I do some, let's call it Yahoo Finance, actually. Yahoo Finance, yeah. Right? Is this screen getting shared here? I think so, yeah. Yahoo Finance, yeah. In Yahoo Finance, I open it and I type in GlaxoSmithKline. So guess what? GlaxoSmithKline is listed in Germany, in New York, and in London Stock Exchange. I have to decide first which stock exchange I'm talking about. Okay, I choose, because GlaxoSmithKline is a British origin company, so I choose LSE, yeah, London Stock Exchange. So they.
How about in the Air France-KLM?
Sorry?
In Air France-KLM, Amsterdam or Paris?
I would say that, well, we can check, for example. Did you say KLM?
Yeah, Air France-KLM. Which one?
Air France KLM, that's Paris. So it's Paris, or maybe this one. No? But that's what's it? Yeah. What is the symbol of this now in Amsterdam? Let me check. I can check it, for example, this one.
Just to know which one.
Yeah, you have to look for the symbol. KLM, Royal Dutch Airlines.
Yeah, but it's part of Air France-KLM, which is bigger group, which will make the assumption.
You can check, you can ask whether they're taking the group or the KLM. Maybe have a word with those people that you have the same annual report with you. Okay, to the GlaxoSmithKline. GlaxoSmithKline LSE. Yeah. If you want to see the data of dividends, always go to the historical data. Yeah. Historical data. And when you see the historical prices, you can change the date, by the way. For example, if you want to get the data of not 2019, but let's say 2000, 22nd of September, I would say 01, 1st of 01, 2000. And if you want to check the dividends only, can you see here dividends only? And then apply. So you can get the dividends given by the company for the last chosen years. Yeah, because these are, yeah, the currency is in GBP. So it will show you which currency unit you're talking about. because it's GlaxoSmithKline, and I chose, if I had chosen GlaxoSmithKline in NYSE, New York Stock Exchange, the prices would have been in US dollar. So yeah, also. So be careful which exchange you choose the company in. The same company can be listed in multiple stock exchange, because companies know, the global companies, even though they have a country of origin, but they're not very nationalist. they go abroad. Even in one country, the company can be listed in more than one stock exchange. It's possible. Okay, and that's what I have already. So you can see that you can download the data. If you have a problem in downloading, you can just copy and paste. You can just select the information and put it in the spreadsheet. But anyways, because I have it, I don't want to go in this downloading stresses. I have this data already, so I share on my spreadsheet with you, which is valuation model, I guess. Yeah, this is one. Yeah, this is what I have. And you can see that I get the same data almost. So I have this data of dividends. So I have the dividends data for the last 20 years of the company. And you can see one thing, that almost every year there are 2002, 2002, 2002, 2002, 3, 3, 3, 3. Even in the latest years, they have paid, in this year they have paid only 3 times. Feb, May. So I hope that they will pay at least one more, because no, actually yes, they are paying 4 times a year dividend. So if you look at the history, the company's tradition is that they are paying dividend 4 times. So it's after every quarter, 3 months, they pay dividend, basically. Okay, and companies, it's more like a tradition. You know, companies normally don't change their tradition. Dividend is very customary thing. It's like a ritual thing. So they don't change it so often. Okay, so I expect that this company would pay once more. And you can see that even the months are same. The first dividend they pay in Feb, then May, then August, then November. So this is how they proceed. So the November dividend is due, but we don't know how much they pay. But it's very likely that they would pay.
What does it mean, 19?
Huh?
What 19?
19 pounds. 19 pounds.
Pounds.
Yeah, 19 pounds. And here you can see that I have given the source. So there is a full URL in case you miss out. And I know 60. In 2000 here, I combined all the quarters. You know, there are 4 quarters. Yeah. So what I did, I plus all the 4 quarters and put it 60. How it's 60? Because in 2000, they have paid 22 in the first quarter, 15, which make 37, and then 37 plus 23, 60. Okay. So in the past, they used to pay 3 times, but now for the last few years, they have been paying 4 times. So then I plus all the dividends in a year, whether 3 times, 4 times, and then I make a list of the total data. So 2000, they pay 60, but in 2001, they only paid 27. Maybe 2001 was not a good year for the company. You can see here, for example, White's 27. Well, they paid 9, 9, and 9. So 27, what can we do? We have to believe what they do. And then so on and so forth. We have data of dividend for each year. And you can see that 2017, 18, sorry, and 19, yeah. I'm not counting 2020 yet, so only 2019, okay? And 2009, because 2020 is not complete year yet. Yeah, and then we have this data, and you can see from here that how much growth is taking place. Year dividend, and you can see that how much is the dividend growing each year. And 2018, 19, and this. Mm-hmm. 2020 is not full yet. Of course, as I said that they have November, but I wrote a note here. Since the dividend pattern is same as in 2019, so I assume that dividend paid will be same as in 2019. So it's my assumption. Okay, so I assume that the company would pay 80 pounds for each share in 2020 as well. So that's my estimate. And then I look at the company's growth prospects. And where do you see them? Once again, either you can make some estimate, but Yahoo Finance, once again, is a fair of, so I and you can see here, if you go up, you goodness me. So if you go here, for example, no. Wait a sec. If you go here, not this, maybe I go a step back. GlaxoSmithKline. Ah, it's here. Yeah. Summary chart. Analysis, actually. Yeah, analysis. This is very annoying, to be honest. And the estimate is that the company would grow for the next 5 years. I can show you where it shows. The next 5 years, you can see here where my cursor is. The estimate is that the company would grow at 4.86%. So I make it roughly 5%, okay? And that is why, this is exactly why I wrote here, let me share again. This is why I wrote here 5%. Okay, so basically I estimate that this will be 5%, but then I also consider that if it is 5% and then the 5% you have now is not same as 5% next year, and so on and so forth. So I make some kind of regression that maybe after 2 years it will be 4.25, then 3.5, and eventually this 5% would be equal to 2% of now. So I make some kind of estimate that the terminal, that the final, and I call it what? I call it forecast growth rate 5% and the perpetual growth rate 2%. That then eventually it will slow down at 2%, 5%, because this 5% can never be endless. And one more reason I chose 2%, because I know that this COVID is now there in the picture, and the company would definitely have, like any other company, GlaxoSmithKline will also have this impact for a long time. So that's why I was a little bit pessimistic in my estimate. If today's world was like in the middle of 90s, the 1990s decade, for example, was fantastic for the stock market. If this year was a promising year, then my perpetual growth rate could have been same or maybe even higher. Okay, because we are living in some depressing times, in some dangerous times, risky times. So therefore, I deliberately put the perpetual growth rate. Perpetual growth rate means which will be end growth rate, 2%. And then the growth factor would be, I divide for 4 years, between 4 years, so eventually what I do, you can see that for the first year, I put 5%, but then I reduce, I reduce it. Can you see that? I am reducing this 0.075% every year till that I get finally 2%. So this is how we make some kind of estimate that how the growth rate, how it will grow. And then you can see that 5%. So this is the rate of growth. So I expect that in 2021, the shareholder would get 84 pounds as dividend. In 2022, the shareholder would get 87.57 as dividend. In 2023, the shareholder would get almost 90 something. And in 2024, the shareholder would get 93. And when the dividend growth rate is only 2%, the shareholder would be getting about 95 pounds. And I call them as 20 as year 1, 21, 22, 23, 24, 25. So I make some kind of estimate for this thing. Yeah, makes sense? So far the story is very clear. So I have, what do I need? You have seen the questions, yeah? I showed you some questions in the PowerPoint. What do you have? You have the expected stock price, you have the dividend, and you have the growth rate of dividend, So we have the dividend growing, and we have the dividend growth rate, and we also know how long we go. We go up to 2025. The question is, what is the rate of discount? We haven't got the rate of discount yet. If you go back to the spreadsheet and come here, I wrote here discount rate, which we always call as small r. And I wrote a note here. This is derived through CAPM or WACC. I hope you know, we have just done them before we went to the break, that we can find out either by CAPM or weighted average cost of capital. I ask you something, for a company like GlaxoSmithKline, would you be finding the discount rate from CAPM or from WACC? What do you think is a better estimate? Why?
They have a lot of intangible assets.
They do, but GlaxoSmithKline is a massive company and they have a lot of tangible. It's not a small R&D firm. And by the way, GlaxoSmithKline is not an R&D company. It's a pharmaceutical company. They have a lot of tangible assets, plants where they make medicine, manufacture medicine.
Yeah, but they also, I think they have, in scale, they have more intangible assets.
Check in the balance sheet, okay? I can't say yes or no yet. I can't say yes or no, but you decide, you guys decide, okay? But for WACC, it's not a bad idea to double check. My hunch is that we still go for WACC because it's a very old company, grown over time. Of course, they carry on with their, it's like saying now that is Microsoft tangible or intangible? It's more tangible now over time. It was a small company, then it was more intellectual capital oriented, but now it has more buildings and all the physical infrastructure as well, growing over time. Yeah, but it's worth a try. It's not a bad idea to look at the assets of GlaxoSmithKline and see what is the ratio. So I leave this discussion open. And then guess what? This 2.810 come. I mean, if it is my assumption, I would take a simple rate, not 2.810. But guess what? There is a second part of the spreadsheet. I calculated beta of. So what I did, GlaxoSmithKline return, and I got the slope with the FTSE 100. FTSE Financial Times Stock Exchange is an index we use in Great Britain, in the London Stock Exchange. Okay, and I chose FTSE 100 because it shows the top 100 companies in Great Britain, and GlaxoSmithKline is definitely in one of the top, among the top 100 companies. So I chose this index, and then I find that beta is 0.20, and then I calculate CAPM, you know CAPM, and when I apply, and the risk-free rate for the last 10 years has been about 0.5% to 3.5% in Britain, okay? And by the way, this data where I chose this risk-free rate should be there somewhere. I think I pasted the link somewhere. If not, I'll do it. And because I know anyways, risk-free rate, I took 2% based on the historic last 20 years. And then I apply CAPM once more. Yeah, and it comes to be how much? 2.81 something, which I write here, that this could be the discount rate. Okay, and then I calculate, if I know that in 2020 we get 80 in the year one, and then I apply this formula, discounted cash flow, remember? So the $80, sorry, is it dollars? No, pounds. So the 80 pounds which you get. So I have a base year for this calculation 2019, yeah, because that's a complete year, okay? So my base year is 2019. So my estimate is that the $80 pounds which you get in 2020 are worth 77 something 2019. The 84 pounds which you get in 21 are worth 79.47 in 2019. The 87.57 pounds which you get in 2022 are worth 80.58 in 2019. So just the discounted cash flows. And then finally, in the final year, you can see here, remember in the final year, you get the dividend, but also you have the estimated. So here I estimate the share price. And the way I did, exactly copied and pasted from the slide which I showed you, that the estimated share price of GlaxoSmithKline by the end of 2025 would be 11,727. And then based on that, yeah, we make an estimate that including dividend and everything, this is what you get. And when you sum it up, it comes to be this. So I just summed everything. Remember, we were having the sigma sign, adding everything, yeah? And that comes to be 10609, okay, which is quite high. One reason is this price is very high because we are using very low discount rate, which is just 2 point something. And when I compare with the current price which I saw yesterday, you have to trust me that yesterday when I saw Yahoo Finance on 21st of September 2020, it was 1485. So you can see that there's a very high likelihood that this stock will go up because if you look at the rate of discount is very low. The rate of discount which company has been using is very low. So there's a high chances of that the GlaxoSmithKline would be overvalued next year. If you want, I can show you. Yesterday, when I was checking the prices of GlaxoSmithKline, it came out to be, yeah, so today is 1477, and yesterday it was about 1485. So basically, yeah. So this, based on the given estimate, of course, this is a very basic calculation. Remember, this is not a very sophisticated calculation, but this is a very beginner level of calculation. We assume here, which is a big flaw, that the rate of discount in 2020 will be same as the rate of discount in 2025. You know, the first mistake which you can do is that you think like the example I gave you, 25,000 each year, 25,000, and you don't consider the risky cash flow at all. The second mistake you do is that even though you recognize that the rate of discount is important, but you keep it constant. Okay? Always, more you go in the future, more would be your cash flow risky. So I would say that with the time, if I become more realist, I should have higher, I shouldn't take one rate of discount. I should even revise my rate of discount more and more and more. More you go. I mean, if somebody asked me to estimate the stock price in 2022, and then say, now you estimate for 2032, I would put more risk rate of discount on 2032 price rather than on 2022. Okay, so this consideration you can give. So this is a basic calculation, and based on this calculation, GlaxoSmithKline seems to be highly overvalued stock in the future. Yeah, of course, if I change rate of discount, for example, if I choose the rate of discount, let's say 8%. Look, if I take the rate of discount, then my estimate is is low. Okay, so if I take well, it's not a bad idea. I'll tell you something. You try the same thing with multiple rates of discount. Are you with me? You try with the CAPM, you try with WACC, and you also slightly take exaggerated rate of discount. You know, if your WACC is 3% and CAPM is 4%, I would say start from 3% and go up to 5, 6, 7, 8%. So you can have a rate of discount separately for each scenario. We call it scenario analysis. Scenario analysis means when you think first very optimist, very flamboyant, and you keep rate of discount very low. And then you start thinking as very pessimist, very conservative, very kind of scared person, and then you put rate of discount up and give the picture to the investor that, hey, this is my estimate that the rate of discount would vary from this to this. If we think as very optimist, look, this is the rate of discount, and this is the outcome value of the stock, which would be very high. And then let's try this. And my hunch is that if the global economy is really good, our rate of discount would be 2%, the minimum you get from CAPM and WACC. And if the global economy is really bad, I don't think we still have worse than 8%. And then in between you change, so you can have the multiple values. So it means that you know that the range of the company stock would vary from this to this, depending upon the circumstances. Okay, so this is the basic valuation model of the company stock. And you can make this estimation. So you know that now when I become more conservative, more pessimist, I find that if my fear turns true, then GlaxoSmithKline would be undervalued in comparison to what we have today. And if I become very flamboyant, very optimist, oh, the good time is there, then it will become too much. Look, the value is so big. You know, if I change the number of decimals, it will go very high. Numbers, maybe. Yeah, so it's huge. It's not possible. And if we, yeah, it's negative because the rate of discount is less. And if we have, for example, 3%, it will change the price estimate. And if we have the higher rate of discount, 5%, for example, it will still be overvalued, but more realistic. And depending upon, as you play with, it depends upon how much you get from CAPM and WACC, right? Remember in FinAir, we got about 3%, yeah? Remember the example we did? If you go by WACC, it was about 3%. No, 2.5%. And if you go by CAPM, it was about 2.75%. So same thing you can do for more period. And that data, don't forget, was from 3rd of March 2020 back to 2000 here. So now I hope you have some basic understanding about valuation, and I would strongly recommend you that now you start working on the real calculation of FinAir and KLM, and start doing your calculation, and based on that start writing the report. The video is recorded. I will be sharing with you, and if you have any problem, then we discuss. And next week when we meet, I will spend first 1 hour still on valuation, right? Still on valuation, 1 hour more. And then in the second hour, after a break, we'll start new topic, which is in our schedule in Optima, right? So thank you very much for your patience, and have a nice rest of the week and the weekend.